What if I told you that the greatest investors on the planet, the men who quietly move billions, reshape industries, and build empires most people never even hear about, have been using the same hidden playbook for decades, and almost no one outside their world knows it exists? And what if that playbook, once locked behind the doors of private equity firms, elite venture funds, pro sports ownership groups, and trillion-dollar family offices, is finally revealed? In the Holy Grail of Investing, Tony Robbins doesn't just talk about money. He takes you inside the war rooms of the world's most successful investors, people who aren't speculating, guessing, or praying for market swings, but engineering wealth with strategies built to survive anything. Market crashes, inflation storms, energy shocks, tech revolutions, you name it. This isn't about day trading. It's not about timing the market. It's not another get-rich-quick idea wrapped in motivational quotes. This is the real blueprint, the 1% of the 1% used to create asymmetric returns, protect their downside, and capture the kind of opportunities the average investor never even sees. You'll hear from billionaire deal-makers who buy entire industries, while the world sleeps, venture capitalists who can spot a future trillion-dollar company before it leaves a garage, private credit giants turning crisis into profit, and energy tycoons shaping the future of global power. And the craziest part? You don't need millions to start applying the same principles. Because once you understand how the wealthiest investors think, how they evaluate risk, how they diversify, how they look for inevitable trends, your entire financial life changes. This book isn't just a guide. It's an invitation into a world you were never supposed to access. And today, we're stepping inside. Chapter 1 opens with Tony Robbins addressing a fundamental problem in modern investing. Most people believe the path to wealth is found in stock picking, market timing, or chasing the latest trend. Robbins argues that this mindset keeps investors trapped in emotional cycles, buying high, selling low, and reacting instead of strategizing. The chapter reframes investing as a discipline built on risk management, not prediction. Robbins introduces the idea that the world's greatest investors, especially those operating in private markets, don't rely on forecasting. Instead, they design portfolios in a way that creates asymmetric outcomes, limited downside, expanded upside, and consistent performance across economic environments. This balance between risk and return is what Robbins calls the Holy Grail of investing. To make the concept concrete, Robbins explores how legendary investors diversify differently from the average person. Retail investors typically diversify within the public market: stocks, bonds, maybe a few ETFs. Elite investors diversify across markets: private equity, private credit, energy infrastructure, venture capital, real estate, and secondary funds. These asset classes behave differently from public markets, often producing steadier returns and less volatility. Robbins explains that access to such opportunities used to be restricted to institutions and ultra-wealthy families, but the financial landscape has shifted. New structures like interval funds, private credit vehicles, and democratized alternative investment platforms are opening the door for everyday investors to benefit from the same strategies used by billion-dollar endowments. A key message of the chapter is that the Holy Grail is not a single asset or magic formula. It is a method of constructing a portfolio that withstands recessions, inflation, rate changes, and geopolitical shocks. Robbins emphasizes that this approach is rooted in principles: protecting principal, compounding capital efficiently, and aligning with long-term, secular trends rather than short-term speculation. Finally, Robbins sets the stage for the rest of the book. Each of the coming chapters will break down specific private market strategies and include insights from top investors who have repeatedly outperformed public markets. Chapter 1 positions the reader to understand that wealth creation at the highest level is not about luck, it's about structure, discipline, and intelligent exposure to alternative assets. Chapter 2 introduces one of the fastest growing segments in private markets: GP stakes investing. Robbins explains that while most investors aim to invest in the funds run by top private equity firms, an entirely different strategy exists, one that allows investors to buy a share of the firm itself. This is called acquiring a GP stake, where investors purchase ownership in the general partner, the entity that manages multiple funds and earns management fees, carried interest, and long-term value from its entire portfolio. Robbins highlights why this model has become so attractive. Traditional private equity investments depend heavily on a fund's performance, which can take years to realize. GP stake investors, however, gain exposure to recurring revenue streams, predictable management fees, steady deal flow, and diversified upside across many funds. This produces a more stable and scalable return profile, one that behaves differently from public equities or single private equity deals. The chapter emphasizes how GP stakes help solve a major challenge for private equity firms: succession planning and expansion capital. As firms grow, they need resources to open new offices, hire specialized teams, build technology platforms, or launch new strategies. Selling a minority stake to a GP stakes investor gives them the capital to scale, without losing control. In return, the investor receives a share of earnings tied to the firm's long-term growth. Robbins describes how specialist firms like Blackstone's Strategic Partners or Dyal Capital have built entire businesses around buying these stakes. They perform deep due diligence, track record consistency, fundraising strength, fund diversification, and the quality of leadership. Their goal is to find firms that can continue generating strong returns across multiple market cycles. The chapter also explains risk dynamics. GP stakes tend to be lower volatility because revenue streams are contractually set and spread across many funds. Still, these investments depend on the GP's ability to continuously raise capital and perform well. If fundraising slows or market conditions shift, revenue can be affected. Robbins underscores that evaluating the durability of a firm's reputation is as important as analyzing the numbers. Ultimately, Chapter 2 shows why GP stakes represent a powerful picks and shovels approach to the private equity industry. Instead of betting on individual deals, investors are buying into the business model behind private equity itself, a model anchored by long-term fee income, diversified exposure, and structural growth. Robbins frames this as a modern pathway for investors seeking institutional-grade stability with private market upside. Chapter 3 explores one of the most surprising alternative investments in today's market: ownership stakes in professional sports teams. Robbins explains that while most people see sports as entertainment, elite investors see something entirely different: a scarce, highly resilient asset class with powerful financial dynamics. The core idea is simple: sports franchises operate in a closed ecosystem. Leagues tightly control the number of teams, which makes supply extremely limited while global demand continues to grow. Because new franchises rarely emerge, valuations tend to rise consistently over time, independent of broader stock market volatility. The scarcity effect is one reason billionaires and private equity firms have poured into the industry. Robbins breaks down the economics behind team ownership. Revenue comes from multiple streams: media rights, licensing, sponsorships, ticket sales, and stadium-related income. Among these, media rights stand out as the engine of long-term growth. As leagues negotiate massive broadcasting and streaming deals, teams capture guaranteed income for years, creating predictable cash flow that institutional investors find appealing. The chapter highlights how the emergence of private equity has transformed the landscape. Historically, only ultra-wealthy individuals could afford to buy a team, but new league rules now allow specialized investment funds to purchase minority stakes. These funds apply rigorous due diligence, examining management, league economics, local market dynamics, and brand strength to determine long-term value. Robbins shows why sports ownership behaves differently from traditional investments. Franchise values often appreciate even in recessions because fandom is emotionally resilient. People may cut discretionary spending, but live sports and the cultural identity tied to teams remain priority consumption. That stability, combined with limited supply, has led to decades of near-linear valuation growth across major leagues. However, the chapter also reviews risks. Minority investors have limited control, liquidity is low, and profits depend on a combination of on-field performance, league decisions, and market conditions. Robbins underscores that investors must evaluate governance structure, leadership quality, and the long-term competitive position of the franchise. In the end, Chapter 3 positions pro sports ownership as a home run alternative investment, high entry cost, low supply, and strong appreciation potential. Robbins presents it as a strategic asset class for investors seeking cultural relevance, durable value growth, and participation in one of the world's most influential entertainment ecosystems. Chapter 4 introduces one of the most rapidly expanding areas in alternative investments, private credit. Robbins explains that private credit, also known as direct lending, has grown into a trillion-dollar market as banks have pulled back from corporate lending. This shift accelerated after the 2008 financial crisis, when regulations like Dodd-Frank limited the ability of traditional banks to lend to mid-size and private companies. The gap created a massive opportunity for non-bank lenders. Robbins outlines the fundamental structure of private credit. Instead of companies borrowing from banks, they borrow directly from private funds that specialize in underwriting loans, structuring deals, and managing credit risk. These loans often come with higher interest rates, stronger covenants, and collateral protections that reduce downside risk for investors. The result is an asset class that typically produces steady, contractual income with lower volatility than public markets. A central theme is risk control. Robbins highlights how leading private credit managers perform deep due diligence, analyzing cash flows, leadership capability, industry trends, and the borrower's ability to service debt across different market environments. Unlike public bond investors, private lenders negotiate terms, interest rates, covenants, collateral, and restructuring protections directly with borrowers. This creates a more resilient risk-reward profile. The chapter breaks down the different types of private credit strategies: senior secured loans, unitranche loans, mezzanine financing, asset-backed lending, and specialty finance. Senior secured loans sit at the top of the capital stack, offering the strongest protection. Unitranche structures blend senior and subordinated debt into one facility, providing simplicity for borrowers while offering higher yields for investors. Robbins emphasizes why private credit has performed well in volatile environments. Because loans are typically floating rate, rising interest rates increase investor returns. And during downturns, private credit managers can renegotiate terms, enforce covenants, or restructure deals, tools public credit investors lack. The chapter also acknowledges risks. Illiquidity is significant, and defaults can rise during economic stress. Investor outcomes depend heavily on the quality of the lending team and its ability to manage distress. Robbins stresses that manager selection is critical. Top firms have decades of experience navigating cycles and protecting investor capital. Chapter 4 concludes by positioning private credit as a cornerstone alternative asset, income-focused, structurally protected, and increasingly essential in institutional portfolios. Robbins frames it as a modern solution for investors seeking predictable cash flow without relying on public bond markets. Chapter 5 begins by stating a hard truth: the global economy runs on energy, and every major advance from transportation to manufacturing to digital infrastructure depends on stable, scalable, affordable power. Robbins emphasizes that energy isn't just another sector, it is the backbone of every other industry. Because of this, energy investment plays a critical role in long-term portfolio construction, especially for institutions and sophisticated investors. Robbins explains how the energy landscape has undergone major structural shifts. Historically, oil and natural gas dominated global supply, but over the last 2 decades, technological improvements, geopolitical pressures, and policy changes have diversified the mix toward renewables, nuclear, and advanced storage technologies. Even so, Robbins stresses that traditional energy continues to supply the majority of global demand and, well, for decades, this mismatch between public perception and actual consumption creates opportunities for disciplined investors. A key insight from the chapter is that energy markets move in long, cyclical patterns. These cycles are influenced by supply constraints, underinvestment, geopolitical conflict, and shifting demand. Robbins notes that long periods of low commodity prices often lead to inadequate capital investment, which sets the stage for future shortages and price spikes. The investors who understand these supply-demand imbalances can position themselves ahead of structural trends. The chapter highlights how top energy investors evaluate opportunities. They look beyond daily price movements and analyze factors like reserve quality, production efficiency, infrastructure capacity, and regulatory environments. Robbins emphasizes the importance of midstream infrastructure pipelines, storage systems, and transport networks which often generate steady, contracted cash flows that behave more like utilities than volatile commodities. Robbins also explores how global population growth and rising living standards will increase long-term energy needs. Even with aggressive renewable adoption, the world will require massive investment in all forms of energy. This includes natural gas, which serves as a bridge fuel, renewables, which require large-scale storage solutions, and new technologies such as carbon capture and modular nuclear reactors. The chapter concludes by framing energy not as a bet on commodity prices, but as a strategic investment category tied to long-term global demand. Robbins positions Part 1 as the foundation for understanding why informed energy investing requires patience, technical analysis, and a clear understanding of global economic trends. Chapter 6 continues the deep dive into the global energy system, shifting the focus from macro demand drivers to the investment mechanics behind today's most influential energy strategies. Robbins argues that the modern energy landscape requires investors to understand both traditional hydrocarbons and next-generation technologies, because the future will not be powered by a single solution, but by a diversified energy matrix. A central theme of the chapter is the capital-intensive nature of energy. Whether it's drilling wells, constructing pipelines, building wind farms, or installing battery storage, every part of the energy ecosystem requires massive upfront investment and long development timelines. For this reason, the most successful energy investors specialize in understanding multi-year trends rather than trying to time short-term commodity cycles. Robbins highlights how disciplined capital allocation, deploying money only when supply-demand fundamentals are favorable, is a key competitive advantage. The chapter also examines the evolution of renewable energy. Robbins notes that while solar and wind have achieved tremendous cost reductions, their intermittency creates challenges for grid reliability. As a result, institutional investors evaluate renewable projects through a risk framework that includes geographic stability, long-term power purchase agreements, PPA letters, regulatory incentives, and the availability of storage solutions. These elements determine whether a renewable project functions as a stable income-producing asset or a high-risk venture. Robbins then addresses natural gas, positioning it as a transitional fuel. Global demand for liquefied natural gas, LNG, has grown rapidly, driven by developing economies and countries looking for cleaner alternatives to coal. Investors focus on LNG export terminals, shipping networks, and long-term contracts that provide predictable cash flows with lower sensitivity to short-term price swings. The chapter also explores emerging technologies: small modular nuclear reactors, advanced geothermal, carbon capture systems, and utility-scale batteries. Robbins explains that while these technologies carry higher uncertainty, they represent long-duration optionality for investors who can tolerate risk in exchange for potential structural upside. Robbins closes the chapter with a key message: energy investing is ultimately about understanding inevitability. Population growth, rising industrial demand, digital infrastructure, and electrification trends all point toward long-term energy expansion. Investors who can analyze infrastructure constraints, regulatory environments, and technological adoption curves are positioned to capture durable returns that persist across decades. Chapter 7 shifts the focus to one of the most dynamic segments of private markets: venture capital, VC. Robbins explains that VC is the engine behind many of the world's most transformative companies, those that redefine industries through technology, innovation, and new business models. while public markets react to innovation after it happens. VC investors aim to identify it before the world recognizes its value. Robbins begins by breaking down the core mechanics of venture capital. VC firms invest in early-stage companies in exchange for equity, taking on high uncertainty in return for the possibility of exponential returns. Unlike private credit or real estate, the payoff distribution is asymmetric. Many investments fail. A handful break even, and a few become home runs that generate outsized gains. The power law dynamic is central to the math of VC. A major theme of the chapter is the importance of identifying disruptive technologies, which Robbins describes as innovations capable of reshaping economic behavior at scale. Examples include artificial intelligence, cloud computing, fintech, biotech, and climate-focused tech. Robbins emphasizes that top VC investors don't chase trends, they look for foundational technologies with long-term adoption curves and significant market expansion potential. Robbins highlights how elite VC firms conduct due diligence differently from traditional investors. Instead of analyzing earnings or cash flow, which early-stage companies rarely have, they evaluate the founding team, product-market fit, scalability, defensibility, and whether the company is positioned inside a megatrend. These investors look for inflection points, moments when technology shifts from early adopters to mass market. The chapter also explains the structural advantages VC firms have built over decades: networks of founders, access to proprietary deal flow, and the ability to help startups scale through operational support. Robbins underscores that success in VC is rarely about luck. It's about building an ecosystem where companies can grow faster and more efficiently. Robbins acknowledges the risks. Venture capital is illiquid, highly volatile, and dependent on long-term execution. Market cycles can influence valuations and exit routes. However, historically, VC has been a primary driver of wealth creation because it captures innovation at the earliest and most undervalued stages. Chapter 7 concludes by positioning VC as a strategic component for investors seeking exposure to technological disruption, asymmetric upside, and the long-term evolution of global industries. Robbins frames it as an essential building block for portfolios designed to participate in the future, not just observe it. Chapter 8 examines why real estate remains the largest and most foundational asset class in the world, even as financial markets evolve and new alternatives emerge. Robbins explains that real estate is not a monolithic category. It is a diverse ecosystem of income-producing assets that generate predictable cash flow, provide inflation protection, and offer long-term appreciation driven by fundamental human needs. The chapter begins by highlighting the structural demand drivers supporting global real estate: population growth, urbanization, limited land supply, and the ongoing expansion of digital and service-based industries. Robbins notes that while the public tends to focus on residential housing, institutional investors concentrate on commercial segments such as multifamily, industrial logistics, data centers, medical offices, self-storage, and specialized infrastructure. Robbins explains how commercial real estate generates returns through two engines: one, rental income, and to asset appreciation. Rental income is tied to long-term leases, which provide stability and resilience across market cycles. Appreciation is driven by economic growth, development scarcity, and improvements made to the property. The combination could behave differently from equities, offering lower volatility and consistent yield. A major point in the chapter is the distinction between core plus, value add, and opportunistic strategies. Core assets focus on stability, newer buildings, high occupancy, and strong locations. Core Plus offers slightly higher returns with moderate risk. Value Add involves improving or repositioning assets to enhance income. Opportunistic strategies take on the most uncertainty, targeting ground-up development or distressed properties. Robbins stresses that investors must align their risk tolerance with the appropriate strategy. Robbins also covers the rise of real estate's new economy sectors. Industrial warehouses are surging due to e-commerce demand. Data centers are essential for cloud computing and AI. Life science properties support biotech expansion. These categories benefit from long-term structural tailwinds that are less sensitive to traditional economic cycles. The chapter acknowledges real estate risks, interest rate exposure, leverage sensitivity, regulatory constraints, and cyclical downturns. But Robbins emphasizes that sophisticated real estate investors mitigate these risks through strong underwriting, conservative debt structures, and operational expertise. Ultimately, Chapter 8 positions real estate as a core pillar of institutional portfolios, offering durability, income, and diversification benefits. Robbins frames it as a strategic asset class that continues to anchor wealth generation across generations precisely because it fulfills essential economic functions and captures long-term global trends. Chapter 9 explores one of the most misunderstood but strategically powerful segments of private markets, secondary investing. Robbins explains that while most investors focus on primary private equity funds committing capital at the start of a fund's life, secondary investors step in later, buying existing fund stakes or portfolios at negotiated prices. This gives them access to assets that are already partially developed, de-risked, and often discounted. Robbins begins by outlining why the secondary market has grown dramatically. Institutional investors such as pensions, endowments, and family offices often face liquidity needs, portfolio rebalancing requirements, or strategic shifts that force them to sell private equity positions before the funds fully mature. Secondary buyers provide a solution by purchasing these positions, giving sellers liquidity and buyers immediate exposure to seasoned assets. A central advantage of secondary investing is improved visibility. Instead of investing blindly into a 10-year fund with unknown outcomes, secondary investors can analyze the underlying companies, evaluate performance, and model cash flows based on real data. This reduces the blind pool risk inherent in traditional private equity. Robbins also highlights the discount dynamic because sellers often prioritize liquidity over price. Secondary buyers can purchase fund stakes below their net asset value (NAV). These discounts create the potential for attractive risk-adjusted returns, especially when combined with shorter duration. Secondary investments tend to return capital more quickly because the underlying assets are already partway through the value creation cycle. The chapter outlines several types of secondary transactions: LP stake purchases, GP-led restructurings, tender offers, and continuation funds. GP-led deals have become increasingly common, where general partners move high-performing assets into a new vehicle to extend their hold period. Secondary investors join these deals to gain exposure to proven companies with strong management teams. Robbins stresses that the key to successful secondary investing is rigorous underwriting, deep portfolio analysis, and understanding the motivations of both sellers and general partners. Top secondary firms leverage sophisticated data models, long-term industry relationships, and a broad view of market pricing trends. Risks exist: pricing inefficiencies, market cycles, and potential overpayment if assets decline. But Robbins notes that historically, secondary investments have offered lower volatility, faster cash returns, and strong downside protection relative to other private market strategies. The chapter concludes by positioning secondaries as a practical, efficient way for investors to access private markets with greater transparency and reduced uncertainty, making it a valuable tool for building resilient, diversified portfolios. Chapter 10 focuses on Robert F. Smith, founder of Vista Equity Partners, and one of the most consistently successful investors in the history of private equity. Robbins presents Smith as a prime example of how deep specialization combined with disciplined systems can produce extraordinary long-term performance. Unlike traditional buyout firms that invest across many industries, Smith built Vista with a laser focus on enterprise software, a sector defined by recurring revenue, high switching costs, and mission-critical products. Robbins explains the core insight behind Smith's strategy. Enterprise software companies behave more like utilities than traditional tech businesses. Their customers depend on them for essential operations, finance, HR, logistics, compliance, which creates durability and predictable cash flow. This stability allows Vista to acquire companies, improve operations through standardized processes, and scale them with lower risk compared to cyclical industries. A major theme is Smith's value creation playbook, a structured set of operational practices that Vista applies across all portfolio companies. Robbins describes how Smith identified repeatable patterns in successful software operations, efficient pricing models, streamlined customer onboarding, optimized sales processes, and strong renewal and upsell strategies. Instead of relying on intuition, Vista uses data-driven systems to improve performance after acquisition. Robbins highlights the importance of recurring revenue in Vista's model. Software companies with subscription-based income offer visibility into future cash flows, enabling more accurate underwriting and stable leverage structures. This recurring revenue foundation also accelerates value creation because incremental revenue often carries high margins. The chapter also addresses Smith's engineering mindset. Before becoming an investor, Smith was a chemical engineer at Goodyear and Kraft, then a tech banker at Goldman Sachs. His analytical training shaped Vista's emphasis on process, measurement, and improvement. Robbins uses Smith's story to illustrate how discipline, not personality, drives consistent returns. Robbins acknowledges that software investing is not risk-free. Competition, technological disruption, and integration challenges all pose threats, but Vista's specialization allows it to evaluate risk with greater precision than generalist firms, giving it an advantage in sourcing, pricing, and managing deals. Chapter 10 ultimately frames Robert F. Smith as a blueprint for how focused expertise plus operational excellence equals durable outperformance. Robbins uses Smith's journey to show that mastering one domain deeply and systematically can generate extraordinary results in private markets. Chapter 11 centers on Ramsey Massalam, CEO of Veritas Capital, and one of the most influential figures in private equity focused on government-related industries. Robbins uses Massalam's strategy to illustrate how investing in companies that serve the U.S. government, one of the largest and most reliable customers in the world, creates a unique blend of stability, long-term demand, and mission-critical value. Robbins explains that Massalam's investment approach focuses on businesses operating at the intersection of technology, national security, healthcare, and government infrastructure. These companies deliver essential services: cybersecurity, data analytics, defense software, intelligence systems, healthcare IT for federal programs, and critical operational support. Because these functions are foundational to national stability, they benefit from durable budgets and long planning cycles. A key insight in the chapter is that government spending behaves differently from corporate spending. While private sector budgets rise and fall with economic cycles, government procurement, especially in defense, intelligence, and public health, remains steady. Robbins emphasizes that this consistency reduces revenue volatility, making these companies attractive targets for private equity firms that value predictable cash flow. Ramsey Massalam is highlighted for his operational discipline. Robbins describes how Massalam and his team evaluate companies' technical capability, contract structure, compliance obligations, competitive positioning, and long-term mission relevance. Government contractors must meet strict requirements, which creates high barriers to entry and protects incumbents. This built-in defensibility is a core part of Veritas's value thesis. The chapter also covers how Veritas improves companies post-acquisition. Massalam's strategy focuses on upgrading technology, strengthening cybersecurity frameworks, navigating complex regulatory environments, and scaling operations in areas where government demand is expanding, especially in AI-enabled defense, digital modernization, and healthcare IT transformation. Robbins points out that the government's increasing reliance on private sector partners driven by technological complexity creates structural tailwinds for this investment category. Modern warfare, cyber defense, and healthcare infrastructure require specialized expertise that government agencies often outsource. This shift increases long-term opportunity for firms like Veritas. Risks exist, and Robbins acknowledges them: regulatory changes, political cycles, procurement delays, and reputational sensitivity must all be managed carefully. Successful investors in this sector need deep domain knowledge, strong compliance frameworks, and the ability to navigate bureaucratic processes. Chapter 11 ultimately positions Ramzi Musallam's strategy as a playbook in investing, where stability meets national mission. By aligning with the needs of the U.S. government, investors gain exposure to long-duration demand, high barriers to entry, and mission-critical technology, making it one of the most resilient segments in private equity. Chapter 12 highlights Vinod Khosla, founder of Khosla Ventures, and one of the most influential investors in high-risk, high-reward technological disruption. Robbins uses Khosla's philosophy to illustrate how breakthrough innovation often comes from ideas that seem impossible, counterintuitive, or too early for mainstream investors to appreciate. Khosla's approach represents the extreme edge of venture capital, where uncertainty is highest, but the potential impact is transformative. Robbins explains that Khosla's investment strategy centers on identifying technologies capable of reshaping entire industries, not merely improving them. These include deep tech, renewable energy, advanced materials, AI, robotics, food technology, and medical breakthroughs. Khosla is known for backing companies at stages when the technology isn't fully proven, betting on scientific and engineering potential rather than existing market traction. A key theme in the chapter is Khosla's belief in black swan positive outcomes. While most investors avoid uncertainty, Khosla seeks it because it's where exponential upside lives. His philosophy is built around asymmetric bets. Even if 9 companies fail, one massive success can outperform traditional portfolios. This non-linear math defines his entire framework. Robbins highlights how Khosla evaluates opportunities instead of focusing on financial projections. He asks, does the idea fundamentally change how a problem is solved? Is the technology defensible and scalable? Is the founding team capable of navigating scientific and technical complexity? If the company succeeds, does it create an entirely new market? This approach requires patience and resilience. Many Khosla-backed companies face long development cycles, regulatory challenges, or scientific hurdles. But Robbins notes that Khosla's background, co-founder of Sun Microsystems and trained engineer, gives him the technical depth to assess frontier technologies with more confidence than generalist investors. The chapter also explains how Khosla challenges conventional thinking inside Silicon Valley. He openly criticizes trend following, incremental innovation, and risk aversion. In his view, transformative progress requires embracing failure as a necessary cost of radical advancement. This outlook has allowed Khosla Ventures to back category-defining startups in healthcare, energy, and AI long before they attract mainstream attention. Robbins also acknowledges the risks: technological uncertainty, long timelines, capital intensity, and binary outcomes. But he emphasizes that Khosla's approach demonstrates why investing in disruptive technology is essential for capturing the future of global growth. Chapter 12 ultimately positions Vinod Khosla as an example of how visionary thinking, technical conviction, and willingness to embrace uncertainty can unlock breakthroughs that reshape economies and generate asymmetric financial returns. Chapter 13 examines the rise of Michael B. Kim, founder of MBK Partners, and one of the most influential private equity leaders in Asia. Robbins uses Kim's career to highlight how investing in Asia requires a fundamentally different skill set, one that blends global private equity discipline with deep cultural fluency, long-term relationship building, and a sensitivity to regional business norms. Robbins begins by explaining that Asia's private equity market developed later than the US or Europe, meaning its structure, maturity, and regulatory environment differ substantially. Investors entering the region must navigate varied legal systems, distinct consumer behaviors, and rapidly changing economic conditions. Kim built MBK Partners by mastering these nuances, earning the reputation as a pioneer capable of executing large-scale buyouts in markets once considered too complex for institutional investors. A central theme is Kim's relationship-driven approach. Robbins emphasizes that in many Asian economies, trust and credibility often outweigh purely financial considerations. Kim differentiated himself by spending years developing partnerships with founders, families, and management teams especially in Korea, Japan, and China. This long-term orientation earned MBK access to high-quality deals that global firms often struggled to secure. Robbins highlights how MBK Partners focuses on consumer-driven, service-oriented businesses that benefit from Asia's growing middle class, aging populations, and rapid digitalization. Kim's strategy emphasizes stable cash flow companies with strong market positions, such as retail platforms, healthcare providers, financial services firms, and consumer brands. Another major point is Kim's disciplined operating model. Similar to leading Western firms, MBK applies structured value creation strategies, improving governance, modernizing technology, and expanding product offerings. But Robbins notes that Kim adapts these methods to fit local cultural and regulatory realities, avoiding the cookie-cutter playbooks that often fail in Asian markets. Robbins also discusses the challenges, political risk, currency volatility, regulatory shifts, and cross-border complexities. But Kim's deep familiarity with regional dynamics allows him to mitigate these uncertainties more effectively than generalist global investors trying to enter Asia. Chapter 13 ultimately positions Michael B. Kim as the architect of a modern private equity powerhouse in Asia. His career demonstrates how local expertise, cultural intelligence, and global financial discipline can combine to outperform in one of the world's most dynamic economic regions. Robbins uses Kim's playbook to show that the future of private markets will increasingly depend on investors who understand both global strategy and local context. Chapter 14 focuses on Will Van Loo, founder of Quantum Energy Partners, and uses his investment philosophy to explain how the global energy system is undergoing the most significant transition in modern history. Robbins highlights Van Loo as a rare investor who understands both sides of the energy equation, the ongoing necessity of hydrocarbons and the unavoidable rise of renewable and low-carbon technologies. His approach captures the all-of-the-above future of global energy. Robbins begins by outlining Van Loo's foundational thesis: the world's demand for energy will continue to grow for decades due to population expansion, industrialization in emerging markets, electrification, and data infrastructure growth. Even with aggressive renewable adoption, hydrocarbons, especially natural gas, will remain indispensable. Van Loo views this not as a contradiction, but as a dual-track opportunity. A key theme is capital scarcity in traditional energy. Robbins notes that political pressure, ESG mandates, and regulatory constraints have restricted capital flow to oil and gas, but energy demand hasn't disappeared. This mismatch creates compelling investment opportunities for firms with strong operational capabilities and disciplined underwriting. Van Loo specializes in identifying high-quality assets overlooked by mainstream investors due to headline risk. Robbins also explores Van Loo's strategic focus on next-generation energy infrastructure. This includes pipelines, storage, carbon capture systems, grid modernization, and LNG export capacity. These assets earn stable, contracted cash flows and are critical to ensuring reliability during the global energy transition. They behave more like utilities than volatile commodity exposures. Another core idea is Van Loo's view that the energy transition is technology-dependent, not merely policy-driven. Renewables require scalable storage, improved transmission networks, and more efficient generation technology before they can fully support global power needs. Investors who understand these bottlenecks can position ahead of structural upgrades in the grid and industrial supply chains. Robbins highlights Van Loo's balanced approach, backing innovative clean energy companies while maintaining exposure to essential hydrocarbon assets. His philosophy rejects ideological extremes. He focuses on systems-level thinking, real-world constraints, and long-term trends rather than narratives. Risks include regulatory volatility, commodity swings, and technology adoption delays. But Robbins emphasizes that disciplined capital allocation, strong technical analysis, and strategic infrastructure exposure allow investors to navigate these uncertainties. Chapter 14 ultimately frames Will Van Loo as an investor who recognizes that the future of energy is hybrid. a blend of reliable traditional sources and accelerating low-carbon innovation. Robbins uses Van Loo's playbook to show how investors can profit from the most important structural transformation of the 21st century. Chapter 15 turns the spotlight to Ian Charles, co-founder of Arctos Sports Partners, and one of the key figures behind the institutionalization of professional sports ownership. Robbins uses Charles's strategy to show how the sports industry, once dominated exclusively by billionaires and family owners, has shifted into a sophisticated, data-driven asset class attractive to institutional capital. Robbins explains that Charles recognized a structural opening in the sports market. Franchise values were rising rapidly due to global media rights, digital distribution, and the expansion of fan engagement platforms. Yet many team owners were asset-rich but liquidity-constrained, with limited ways to monetize equity without selling majority control. Charles saw an opportunity to create a new investment category by offering minority stakes. With professional governance standards, a major theme is sports as a long-duration, scarcity-driven asset. Robbins emphasizes that leagues strictly control the number of teams, which makes supply fixed while global demand continues expanding. This constrained supply has historically supported near-linear appreciation in franchise values, regardless of market cycles. Charles designed Arctos to give investors access to these dynamics without the operational burdens or political challenges of full ownership. The chapter describes how Charles built a rigorous analytical framework for valuing sports assets. His team evaluates local market strength, league economics, brand equity, revenue diversity, arena or stadium economics, and potential for international expansion. Robbins notes that this institutional lens was uncommon in sports until recently, allowing Arctos to price minority stakes with far more precision than traditional buyers. Robbins highlights how Charles also focuses on the business evolution of sports, including sports betting, streaming rights, global merchandising, and data analytics for fan behavior. These expanding revenue lines create a more diversified economic model than traditional ticket-driven sports franchises of the past. Risks do exist: limited control over operations, league-level constraints on ownership structures, dependence on commissioner approval, and liquidity challenges. But Charles mitigates these risks by targeting diversified portfolios of teams across multiple leagues and geographies, reducing exposure to any single franchise. Chapter 15 concludes by positioning Ian Charles as a pioneer in transforming sports ownership into an investable, scalable asset class. Robbins uses his strategy to demonstrate how the intersection of scarcity, stable demand, institutional governance, and global media economics can produce a powerful long-term investment opportunity, one that blends cultural relevance with financial durability. Chapter 16 highlights David Sacks, a core member of the legendary PayPal Mafia and a central figure in the evolution of Silicon Valley's startup ecosystem. Robbins uses Sacks's career to illustrate the principles behind building and scaling high-growth technology companies, especially those that operate on network effects and software-driven business models. Robbins begins by positioning Sacks as both an operator and an investor. After helping build PayPal into a dominant online payment platform, Sacks founded and scaled Yammer, one of the earliest enterprise social networking tools. Yammer's rapid adoption, driven by viral internal usage rather than traditional enterprise sales, demonstrated Sacks's ability to identify and exploit bottom-up product adoption models, which later became standard in SaaS. A central theme is Sacks's deep understanding of product-market fit. Robbins explains that Sacks evaluates companies based on how urgently their target users need the solution, how frequently they interact with it, and whether the product becomes embedded into daily workflows. This operational lens allows Sacks to spot companies that possess early stickiness but need capital and strategic guidance to scale. Robbins emphasizes Sacks's focus on network effects, a characteristic he learned to master at PayPal. Products become more valuable as more users adopt them, creating defensibility, rapid growth curves, and high-margin scalability. Sacks looks for companies where usage builds its own moat, making competition increasingly difficult. The chapter also covers Sachs's role as a venture capitalist through Kraft Ventures. Robbins highlights Kraft's thesis, backing SaaS companies with strong unit economics, clear distribution channels, and high retention-driven growth. Unlike traditional VC firms that prioritize hypergrowth at all costs, Sachs emphasizes operational excellence, efficient burn, disciplined fundraising, and scalable architecture. His investment approach blends entrepreneurial experience with analytic rigor. Robbins notes the industries Sachs frequently targets: fintech, enterprise SaaS, productivity platforms, logistics technology, and emerging AI applications. These sectors benefit from digital transformation trends and offer asymmetric upside. For early investors, risks are acknowledged too. Early stage SaaS can suffer from churn, pricing pressure, or weak monetization strategies. Network effects can be difficult to achieve, and competitive markets can shift rapidly. But Sachs mitigates these risks through deep involvement, advising founders on hiring, product decisions, and strategic pivots. Chapter 16 ultimately presents David Sachs as a blueprint for founder-led venture investing. Combining practical experience, product insight, and disciplined operational frameworks, Robbins uses Sachs's career to show how understanding user behavior, scalability mechanics, and economic fundamentals can unlock powerful opportunities in the software-driven economy. Chapter 17 focuses on Michael Rees, the architect behind Blue Owl Capital's GP stakes strategy, and one of the most influential figures transforming how private asset managers finance growth. Robbins uses Rees's work to show how the private markets ecosystem is shifting from a deal-by-deal model into a more institutionalized, scalable, and permanent capital business. Robbins begins by explaining the structural challenge many private equity and alternative asset managers face. Even highly successful firms often need long-term capital to launch new strategies, expand globally, build technology infrastructure, or acquire other managers. Traditional funding, mainly through management fees, can be slow, cyclical, and restrictive. Rees identified a gap. These firms needed growth capital, yet few investors were willing to fund the management companies themselves. This insight gave rise to the GP stakes model, which Rees refined and scaled. Instead of investing in the funds that GPs manage, Blue Owl purchases minority ownership in the general partner entity. These stakes give investors exposure to recurring management fees, carried interest across numerous funds, and long-term value appreciation as the GP scales. Robbins highlights how this creates a diversified, fee-driven return profile with lower volatility compared to traditional private equity. A central theme is Rees's focus on permanent capital. Many alternative asset managers struggle with predictable long-term financing because fund structures require capital to be raised, invested, harvested, and returned. By introducing permanent capital vehicles, publicly traded entities, evergreen funds, and long-dated structures, Rees gave GPs a way to access stable capital while allowing investors to participate in long-duration, scalable returns. Robbins details how Rees evaluates potential GP partners, durability of their investment strategies, fundraising track record across cycles, culture, leadership depth, and succession planning, diversification across asset classes and geographies, embedded growth opportunities through new products or distribution channels. This due diligence framework ensures Blue Owl invests in firms with strong brand equity, disciplined underwriting, and long-term resilience. The chapter also acknowledges risks, valuation uncertainty, competitive pressure among asset managers, regulatory changes, and the potential for strategy drift if firms expand too aggressively. But Robbins emphasizes that Rees mitigates these risks by targeting managers with proven processes, consistent track records, and institutional-grade governance. Chapter 17 ultimately positions Michael Rees as a pioneer redefining how private asset managers finance their future. Robbins frames GP stakes investing as a structural innovation, allowing investors to own the business model behind private markets, not just the assets those businesses manage. Chapter 18 spotlights Bill Ford, CEO of General Atlantic GA, and uses his leadership journey to illustrate how a disciplined, global growth investing platform can evolve from a small family office into one of the most influential private investment firms in the world. Robbins examines Ford's philosophy to show how long-term capital, global reach, and thematic expertise combine to create a scalable and resilient investment model. Robbins begins by explaining GA's origins. The firm initially managed capital for the founding family behind Atlantic Philanthropies, but under Ford's vision, GA expanded far beyond its roots, transforming into a global growth equity powerhouse. This transformation required a systematic approach, building teams across continents, establishing sector-specific expertise, and maintaining a patient, partnership-driven strategy. A major theme is growth equity as a distinct asset class. Unlike venture capital, which focuses on early-stage risk, or traditional private equity, which often relies on leverage and operational restructuring, growth equity targets companies that have proven business models and strong revenue traction, but need capital and strategic guidance to scale globally. Robbins explains that GA specializes in this middle zone where risk is lower than in venture, but upside remains significant. Robbins details Ford's focus on four core sectors: technology, financial services, healthcare, and consumer. Because sector teams build deep domain knowledge, enabling them to evaluate competitive moats, customer retention patterns, regulatory considerations, and international expansion potential. This thematic approach gives GA the ability to identify trends early and deploy capital with high conviction. Another central idea is Ford's commitment to globalization. Robbins emphasizes that successful growth companies often face global demand, but require strategic partners who understand local markets. GA builds long-term relationships with founders, helping them expand into Asia, Latin America, Europe, and the Middle East. This global footprint allows GA to match companies with market opportunities that smaller growth equity firms cannot access. Robbins also highlights Ford's emphasis on partnership, governance, and values-driven leadership. GA operates with a collaborative approach, avoiding the aggressive, control-heavy tactics traditionally associated with private equity. Ford believes that stable governance, aligned incentives, and long-term partnerships create more durable outcomes for both investors and management teams. Risks remain: geopolitical uncertainty, regulatory complexity, and competitive pressures in global markets. But GA mitigates these risks through diversification, deep local networks, and disciplined underwriting. Chapter 18 ultimately presents Bill Ford as an example of how strategic global expansion, sector specialization, and long-duration capital can transform a family office into a world-class investment platform. Robbins frames Ford's model as a blueprint for navigating the interconnected, rapidly evolving global economy. Chapter 19 highlights Tony Florence, longtime leader at New Enterprise Associates (NEA), one of the world's largest and oldest venture capital firms. Robbins uses Florence's career to illustrate how disciplined, large-scale venture investing works and why experience, pattern recognition, and strategic patience are critical in a rapidly evolving technology landscape. Robbins begins by breaking down NEA's unique position in the VC ecosystem. Unlike smaller, specialized funds, NEA operates a multi-sector, multi-stage model, participating in early seed rounds all the way through late-stage growth financing. Florence's leadership shows how this breadth allows NEA to identify emerging categories early, support founders through long development cycles, and allocate capital flexibly based on market conditions. A central theme is Florence's thesis-driven approach to innovation. Rather than chasing hype cycles, he focuses on long-term secular trends: digital transformation, cloud infrastructure, enterprise software modernization, healthcare technology, AI-enabled workflows, and consumer behavioral shifts. Robbins highlights that Florence emphasizes technology as infrastructure, tools, and platforms that become mission-critical to businesses, organizations, and institutions. Robbins describes Florence's method for evaluating early-stage companies. He prioritizes whether the product solves a large, painful problem, evidence of early customer adoption or usage intensity, founders who combine technical excellence with adaptability, business models that can scale efficiently as markets mature. Florence's framework is rooted in signal differentiation, the ability to distinguish real product-market fit from noise. His experience through multiple tech cycles gives him an advantage in identifying which early signals truly matter. The chapter also explores NEAS scale as a strategic advantage. With a large platform, NEA can support companies through market volatility, connect them with talent, assist in go-to-market development, and back them across multiple funding rounds. Robbins notes that this stability helps founders focus on long-term execution instead of short-term fundraising pressure. Robbins highlights Florence's investments in major enterprise and consumer platforms, illustrating how early conviction in transformational technologies can generate exceptional outcomes. But he also acknowledges the risks venture markets face: valuation compression, competitive deal sourcing, and technological uncertainty. Florence mitigates these risks through diversification across stages, sectors, and geographies, balancing higher-risk frontier bets with more predictable growth investments. Chapter 19 ultimately positions Tony Florence as a representation of institutional venture investing done at scale. Robbins uses his approach to show how deep expertise, disciplined pattern recognition, and a long-term orientation enable investors to navigate technological disruption while capturing asymmetric upside in fast-changing markets. Chapter 20 focuses on Bob Zorik, co-founder of InCap Investments, one of the most prominent private equity firms in the energy sector. Robbins uses Zorik's career to highlight how rational, disciplined energy investing works during a period of global transition, where traditional hydrocarbons remain essential even as renewables accelerate. Zorik represents the pragmatic center of energy investing, grounded in fundamental economics, focused on capital discipline, and responsive to long-term structural demand. Robbins begins by explaining how Zorik built InCap into a leading investor in oil and gas. By emphasizing capital efficiency, geological quality, and operational excellence, rather than chasing commodity prices, Zorik's strategy focuses on acquiring high-quality acreage, improving productivity through technology, and maintaining strict cost discipline. The goal: generate strong returns regardless of short-term price swings. A major theme is the relationship between capital availability and energy supply. Robbins notes that political and ESG-driven pressures have pushed many institutions to pull back from oil and gas investment. Zorik sees this not as a threat, but as an opportunity. When capital withdraws from a sector that remains essential, supply tightens and well-run operators can achieve strong cash flows with less competition. Robbins also emphasizes how technological advances have dramatically improved drilling efficiency. Horizontal drilling, seismic imaging, and advanced completion techniques have lowered break-even costs and increased output predictability. For Zorik, technology is a risk mitigator rather than a speculative bet. The chapter then explores Zorik's balanced perspective on the energy transition. He acknowledges that renewables are expanding rapidly, but notes that solar and wind require storage, grid upgrades, and backup capacity often provided by natural gas. Zorik argues that hydrocarbons and renewables are not substitutes, but partners in a long-term transition where both remain vital. Robbins highlights that InCap has also expanded into renewable infrastructure, particularly battery storage, utility-scale solar, and carbon management technologies. This diversification reflects Zorik's belief that investors must participate in both sides of the energy future to build resilient portfolios. Risks are discussed as well: regulatory changes, commodity price volatility, technological disruption, and long development cycles. But Robbins underscores that disciplined underwriting, conservative leverage, and deep technical expertise allow firms like InCap to manage these complexities effectively. Chapter 20 ultimately presents Bob Zorik as a model for clear-eyed, fundamentals-first energy investing, embracing innovation, while staying grounded in the economic realities that will shape global power markets for decades. Chapter 21 examines David Golub, president of Golub Capital, and uses his expertise to show how private credit has evolved into one of the most important pillars of modern finance. Robbins presents Golub as a key architect in transforming private credit from a niche lending strategy into a scalable, institutional-grade asset class, capable of supporting some of the economy's most resilient middle-market companies. Robbins begins by explaining the structural backdrop. After the 2008 financial crisis, regulatory constraints forced traditional banks to reduce corporate lending, creating a vacuum that private lenders stepped in to fill. Golub recognized early that companies still needed reliable financing, but preferred long-term partners who could underwrite complex credit needs more flexibly than traditional banks. Golub Capital built its model around this gap. A major theme is Golub's emphasis on relationship-based lending. Instead of treating loans as transactional products, Golub's team builds multi-year partnerships with borrowers, sponsors, and private equity firms. This approach gives Golub deeper insight into business operations, industry dynamics, and management quality, allowing for more precise underwriting and lower default risk. Robbins highlights the first lien, senior secured focus of Golub Capital. By lending at the top of the capital structure, Golub prioritizes downside protection, collateral coverage, strong covenants, and conservative leverage levels. This risk-first philosophy positions private credit as a stable income generator, especially in environments with rising interest rates, where floating-rate loans provide increasing yields. The chapter also explores how Golub Capital leverages data analytics and credit intelligence. Robbins explains that Golub has built one of the most advanced data platforms in private credit, tracking borrower performance across cycles and industries. This proprietary data enhances underwriting accuracy and enables early detection of potential operational challenges. Robbins emphasizes Golub's disciplined view of market cycles. He avoids overextending during easy credit environments and focuses on durable business models, healthcare services, software, business-to-business platforms, and specialty manufacturing. These sectors offer predictable revenue, strong margins, and lower cyclicality. Risks include economic slowdowns, credit market tightening, and idiosyncratic borrower failures. But Robbins notes that Golub's structure, diversification, and disciplined underwriting significantly mitigate these risks. His firm's long-term performance demonstrates the resilience of well-executed private credit strategies. Chapter 21 ultimately positions David Golub as a defining figure in the maturation of private credit, an investor who combines disciplined risk management, deep sector expertise, and long-term partnership-driven lending. Robbins uses Golub's model to show why private credit is becoming a core allocation for institutions seeking steady income, strong protections, and lower volatility compared to traditional fixed-income markets. Chapter 22 focuses on Barry Sternlicht, founder of Starwood Capital Group, and uses his career to illustrate how disciplined, opportunistic real estate investing can scale into a global platform. Robbins presents Sternlicht as a master of identifying value dislocations, building brands, and navigating shifting cycles within the world's largest asset class, real estate. Robbins begins by outlining Sternlicht's earliest thesis: real estate rewards investors who combine macro awareness, micro-level asset intelligence, and brand creation. Unlike many traditional real estate investors who focus solely on location or price, Sternlicht built Starwood on the idea that real estate assets can be consumer products, experiences shaped by design, branding, and operational excellence. The best-known example is the creation of the W Hotel brand, which transformed the perception of lifestyle hospitality. A central theme is Sternlicht's ability to spot cyclical inflection points. Robbins describes how Sternlicht repeatedly invested when markets were distressed, whether in hotels, multifamily, or commercial assets, using disciplined underwriting and creative restructuring. He specializes in buying assets when fear is high, improving operations, and selling when institutional capital flows back into the sector. The cycle-driven approach is a core component of Starwood's long-term outperformance. Robbins highlights Sternlicht's global diversification. Starwood has invested across the U.S., Europe, and Asia, giving it flexibility to shift capital based on interest rate environments, supply-demand dynamics, and regional economic cycles. This global footprint allows Sternlicht to move into markets with favorable pricing and exit when valuations fully recover. The chapter also explores Sternlicht's focus on real estate-backed credit. In addition to equity investments, Starwood built a major presence in real estate lending, providing financing to developers and owners. Robbins emphasizes that this dual strategy, equity plus credit, creates a more resilient business model, enabling Starwood to earn returns across market cycles while managing risk. Robbins walks through Sternlicht's investment criteria: long-term demographic tailwinds, supply constraints, irreplaceable locations, and opportunities where design or operational improvements can unlock hidden value. Sectors such as multifamily housing, hospitality, industrial logistics, and alternative real estate like student housing often meet these criteria. Risks are acknowledged: rate volatility, leverage sensitivity, regulatory shifts, and local market downturns. But Sternlicht mitigates these risks through diversification, strong underwriting discipline, and a deep operational platform. Chapter 23 serves as the synthesis of the entire book, where Robbins distills insights from the world's top investors into a unified framework. Rather than presenting a single strategy or asset class as the Holy Grail, Robbins emphasizes that the true advantage comes from a disciplined approach to portfolio construction, grounded in risk management, diversification across alternative assets, and long-term thinking. Robbins begins by explaining that nearly every elite investor interviewed across private equity, venture capital, real estate, energy, sports ownership, and private credit follows the same underlying principle: protect the downside first. The wealthiest and most successful investors do not chase speculation. They build systems that make losses unlikely, and they design portfolios where the upside compounds over decades. A major theme is the importance of asymmetric returns. Robbins explains that true wealth creation occurs when investors position themselves in opportunities with limited downside and outsized upside. Many of the strategies highlighted throughout the book, GP stakes, private credit, secondaries, real estate infrastructure, energy assets, and early-stage technology, have asymmetric characteristics when executed with discipline. Robbins then shifts to the second pillar: diversification across private markets. Unlike traditional diversification within public equities, elite investors diversify across uncorrelated alternative asset classes that behave differently during market stress. Robbins emphasizes that these private assets, because they are less volatile, less emotional, and more fundamentally driven, form the foundation of resilient, institution-grade portfolios. Another core insight is the value of long-duration capital. Robbins shows how endowments, sovereign wealth funds, and large family offices think in decades, not quarters. This time horizon allows them to capture the full compounding power of private markets, deploy capital during periods of fear, and avoid panic-driven decision-making. The chapter also stresses the importance of access and manager selection. Private markets are not efficient. Outcomes vary dramatically between average managers and elite operators. Robbins underscores that investors must conduct rigorous due diligence, evaluating culture, process, track record, risk controls, and alignment to access the true benefits of private market investing. Robbins closes by reframing the Holy Grail not as an asset, but as a mindset. Prioritize capital preservation, seek asymmetric opportunities, diversify across alternative assets, think in decades, partner with top-tier managers. Chapter 23 ultimately positions this philosophy as the blueprint for building durable wealth. In a world defined by volatility, technological disruption, and shifting economic power, the Holy Grail of investing delivers one core message: the world's top investors don't rely on luck, predictions, or stock market timing. They rely on structure, asymmetric risk, and long-term thinking. Tony Robbins takes readers inside private markets, revealing how billionaires, endowments, and elite institutions build wealth that's durable, repeatable, and largely insulated from the emotional swings of public markets. Across 23 chapters, Robbins breaks down the investment playbooks of leaders in private equity, venture capital, real estate, private credit, sports ownership, energy, and GP stake strategies. What emerges is a consistent blueprint followed by nearly every legendary investor he interviews. The first pillar is downside protection. Whether it's private credit lenders like David Golub, energy investors like Will Van Loo, or GP stakes pioneers like Michael Rees, the best players start by minimizing permanent loss. They negotiate structures, collateral, covenants, and ownership positions designed to survive market shocks for them. Safety is not the opposite of growth. Safety enables growth. The second pillar is asymmetric return design. These investors deliberately seek opportunities where potential upside far outweighs the risk. Venture capitalists like Vinod Khosla look for breakthrough technologies that could reshape industries. Real estate leaders like Barry Sternlicht create value through branding and operational innovation. Secondary market experts buy de-risked assets at discounts. The goal is simple: build portfolios that rise more than they fall. A third major theme is diversification across uncorrelated private assets. Robbins emphasizes that true diversification doesn't come from owning 50 public stocks. It comes from owning different types of assets: private credit, real estate, venture, energy infrastructure, GP stakes, secondaries, and specialized alternative vehicles. These categories behave differently in recessions, inflation cycles, and rate environments, creating stability that retail investors rarely experience. The fourth theme is long-duration mindset. The institutions Robbins studies, Yale, CalPERS, sovereign wealth funds, invest on a 20, 30, even 50-year time horizon. They know wealth is built through compounding, not constant reacting. Their advantage is patience, not prediction. Finally, Robbins highlights manager selection as the meta skill of private markets. In alternatives, the spread between top quartile and average managers is enormous. Access matters. Process matters. Discipline matters for everyday investors. Robbins encourages partnering with platforms, feeders, and interval funds that offer institutional-grade exposure with lower minimums. In the end, the real holy grail is a mindset. Protect your downside. Seek asymmetric upside. Diversify across private markets. Think in decades. Partner with elite operators. Follow these principles, and you're no longer reacting to markets. You're engineering long-term wealth. If you found this breakdown helpful and want more summaries of the world's most powerful investing frameworks, hit that like button, subscribe, and turn on notifications. It tells YouTube you want more content that actually builds your financial IQ, not just hype. Drop a comment below. Which private market strategy are you most interested in learning about next? And if you want a full series covering every chapter of the Holy Grail of Investing, let me know. I'll create it. See you in the next video. Let's build wealth the intelligent way.